Do you think you need a lot of money to start investing? Think again. In the realm of investing, there's a pervasive myth that you need a hefty sum of money to get started. But in reality, that's far from the truth. You see, investing isn't exclusive to the rich or those with substantial financial means. Even with a small budget, you can begin your journey towards financial growth. It's all about making smart choices, understanding the market, and most importantly, starting early. What truly matters is not the amount you invest initially, but the consistency and the time you allow for your investments to grow. Over time, a little can turn into a lot, and that's the beauty of investing. It's not a sprint, it's a marathon. It's about building wealth over time and creating a secure financial future. So, are you ready to start your investing journey? Let's debunk some myths first. Scene script. Ever heard of the term compound interest? It's your best friend in the world of investing. Take a moment to imagine a snowball rolling down a hill. It starts off small, but as it rolls further, it gathers more snow, growing larger and faster with each turn. This is an apt metaphor for compound interest, a powerful force in the world of investing. Now let's break this down. The concept of compound interest revolves around the idea that you earn interest not only on your initial investment, also known as the principal, but also on the interest that your investment has already earned. It's interest on interest. A cycle of growth that can turn small seeds into mighty oaks over time. Suppose you invest $100 with an annual interest rate of 5%. After the first year, you'll earn $5 in interest, bringing your total to $105. But here's where the magic happens. In the second year, you don't just earn 5% on your initial $100, but on the full $105. That's an extra 25 cents earned, and while a quarter might not seem like much, remember that snowball, it's all about momentum. The power of compound interest becomes apparent when you consider time. The longer your money is invested, the more opportunity it has to grow. Let's say you're 25 years old and you invest $500 annually at an interest rate of 5%. By the time you're 65, you'd have invested $20,000. But thanks to compound interest, your investment would have grown to around $60,000. That's 3 times your initial investment. This is why compound interest is especially beneficial for those investing with a small budget. Every dollar invested is a seed, and the interest earned is the water that helps it grow. The more time you give your investment, the larger it can grow, even if you're only able to invest a small amount. Compound interest is a powerful tool, especially for those investing with a small budget. Remember, every dollar counts. Now that you understand the power of compound interest, let's find out where you can invest your money. Starting off with stocks, they are a popular choice for many investors. When you buy a stock, you're buying a piece of ownership in a company. Stocks offer high potential returns, but are also associated with higher risk. This means that while you have the opportunity to make a substantial amount of money, there's also the possibility of losing your initial investment. Next up, we have bonds. Bonds are essentially loans that investors make to entities like corporations or governments. When you buy a bond, you're lending your money to these entities in exchange for regular interest payments and the return of the original amount at the end of a specified period. The risk is generally lower with bonds, but so are the potential returns. Moving on to mutual funds. These are investment vehicles that pool money from numerous investors to invest in a diversified portfolio of stocks, bonds, or other assets. Mutual funds provide diversification and professional management, but they also come with fees and expenses. The risk and return of mutual funds depend on the underlying assets they invest in. Lastly, we have exchange-traded funds, or ETFs. These are similar to mutual funds but are traded on stock exchanges like individual stocks. ETFs provide diversification, are generally more cost-effective than mutual funds, and offer the flexibility to be traded throughout the day. However, like all investments, they come with their own set of risks. Each of these investment options carries its own set of benefits and risks. Stocks could offer higher returns but carry more risk. Bonds are generally safer but yield lower returns. Mutual funds offer diversification and professional management but come with fees. ETFs offer diversification and flexibility but also carry risk. Choosing the right investment option is crucial. It's all about finding the right balance between risk and reward. Remember, investment is not a one-size-fits-all proposition. It's important to do your research, understand your financial goals, and evaluate your risk tolerance before making any investment decisions. Diversification is not just a fancy word, it's an essential strategy for every investor. So, what exactly is diversification? Well, in the world of investing, diversification is like creating a balanced diet for your portfolio. It's about spreading your investments across different types of assets so that if one of them takes a hit, others can help cushion the blow. Think of it as not putting all your chips on a single number in a game of roulette. Now, why is diversification important? It's all about managing risk. Investing is inherently risky, but diversification helps you spread that risk. If you put all your money into one company's stock and that company goes under, you could lose everything. But if you spread your money across a variety of stocks, a loss in one place can be offset by gains in another. So how can you achieve diversification with a small budget? It's easier than you might think. One way is through mutual funds or exchange-traded funds, often known as ETFs. These funds are like a pre-made investment mix, giving you exposure to a wide range of companies and sectors with just one purchase. This means you don't need a fortune to start diversifying your portfolio. Another way is to invest in different types of assets. Don't just stick to stocks, consider bonds, real estate, or commodities. Each asset class behaves differently under different market conditions. So, diversifying across asset classes can further reduce your risk. And finally, don't forget about international diversification. By investing in foreign markets, you're not only gaining exposure to different economies and currencies, but you're also spreading your risk beyond your home country's borders. Just remember, diversification isn't about chasing the highest returns. It's about reducing risk and creating a more stable, resilient portfolio. And while it can't eliminate risk entirely, it can certainly help smooth out the bumps along your investment journey. Remember, don't put all your eggs in one basket. Diversification is the key to managing risk. Consistency can be a game changer in your investment journey. Let's delve into why this is the case. Regular contributions, regardless of the investment amount, play a crucial role in building your investment portfolio. It's not about how much you start with, but rather how consistently you add to your investments. Imagine you're building a house. You can't just drop a pile of bricks and expect a mansion to appear. Instead, you lay one brick at a time, and over time, you see the structure taking shape. The same principle applies to investing. Whether you're starting with $100 or $1,000, the key is to keep laying those investment bricks consistently. Now, let's talk about a strategy that can help you make the most of your regular contributions: dollar cost averaging. This investment tactic involves consistently investing a fixed dollar amount in a particular investment at regular intervals, regardless of the price. Here's how it works. Suppose you decide to invest $50 every month into a particular stock. Some months, the stock price may be high, and you'll get fewer shares. Other months, the stock price may be low, and you'll get more shares. Over time, you're buying the stock at an average cost, which can help smooth out the highs and lows of market volatility. Dollar cost averaging has a few benefits. First, it instills discipline and encourages regular investing. Second, it eliminates the need to time the market, which can be tricky, even for seasoned investors. Lastly, it allows investors to take advantage of market fluctuations, buying more when prices are low and less when prices are high. In essence, the power of regular contributions and dollar cost averaging is in their simplicity and consistency. They allow you to start where you are, with what you have, and build from there. They help to remove the stress and uncertainty that often comes with investing. Investing is not a one-time event, it's a journey, and consistency can make this journey smoother and more profitable. Remember this as you embark on your investment journey. So you see, you don't need a fortune to start investing. Indeed, the world of investing is not exclusive to those with deep pockets. The journey begins with understanding the undeniable power of compound interest, which can transform even the smallest investments into substantial savings over time. Next, we explored various investment options tailored for small budgets. From low-cost index funds to fractional shares, these options make investing accessible to everyone. We then delved into the concept of diversification, a key strategy in risk management. By spreading your investments across a range of assets, you can cushion the impact of market volatility. Lastly, we underscored the importance of regular contributions. Through dollar cost averaging, you buy more when prices are low and less when they are high, which can lead to significant gains in the long run. Investing with a small budget is not only possible, it's potentially profitable. Start your journey today and see where it takes you. Remember, the best time to start investing was yesterday. The second best time is now.